I would now like to go to Mr. Marvin. You work with Africa Risk Climate Capacity. And what we know across the continent from the data that we have is that Africa aggregate insurance penetration rate is estimated at 2.78% in 1 year, which is well below the global average of about 7.23%. And you've heard from Madame Adama, Guinea is already facing loss and damage. You heard from Dr. Olufonso, who talked about scale matching the need that is happening in the continent. What can be done by African countries to have increased accessibility to insurance? I would like to get your thoughts on this.
Thanks very much, Richard. And I don't have time, so I'll skip all the niceties and go straight to the point. So, yes, you're quite right. The protection gap, as we call it, is 97%. So that basically means that, for all the economic losses that are associated with climate events, only 3% are covered. There's downstream impact in terms of so the initial impact on lives and livelihoods, I think, has already been discussed. But there's also downstream impacts for governments in terms of lost revenue, taxes, and also the wiping away, of development gains. So this is a big problem. But I think the other bigger problem that we have is what I call a risk management gap. So if you speak to most of the countries on the continent, do they have an embedded risk management system that speaks to how they manage the various risks that the population face, and do they have plans to address those risks? So that's really a key problem, because even if you get funding, but if you haven't arranged your framework within the country to assess the risk and respond to the risk, then even if you get the funding, my hypothesis is that you will not be efficient in dealing with the various risks. So we need to establish risk management within the governments as a priority. Then that enables us to deal with the risks. And I also wish that Mark New had spoken first before me, but I'm sure you also hear and you've heard already from other colleagues that the risks are increasing. So what used to be a 1 in 50-year event is now becoming maybe a 1 in 10-year event, or even worse. So what that means is that the cost of insurance is going to be much higher, and in some cases, it's not going to be feasible to insure the events that we used to associate as catastrophic, because it just doesn't make sense. So what that means is that we need more funding now to be allocated to contingency funds or reserves that deal with the more frequent events. The only problem is that those more frequent events are now of a huge magnitude, and this is because of climate change. And the other issue that we've also got is that when you look at the population growth that's focused for the continent, at least 8 to 10 countries are going to experience a doubling in their population to 2050. So what that means is that the exposure is going to increase. The hazards, as we know from climate change, we know that floods, droughts are going to increase in severity. But equally also important, there are going to be new perils that we haven't really spoken about, because they're not really been in the limelight. So here I'm talking about heat waves. A lot of places are going to become unlivable because of the heat. We're also going to see more outbreaks and epidemics, because climate change is going to induce more and more of these things. So from a hazard, it's all going up. From an exposure, it's going up, and from a vulnerability, given all the here and now issues that we're talking about, and the fact that there is no funding, my hypothesis is also that the vulnerability is going to increase. So when you put all these things together.
So, Marvin, let me just jump in there. Let me jump in there. You mentioned risk management gap, and that's very important. But what we also know is that insurance is business, and it will flow to where there is a promise of income, which then means that even the most vulnerable, if they are not able to drive enterprises that build their resilience, then definitely they wouldn't be able to pay back, even if they were to be able to have access to insurance. So my question to you is, there is the Nairobi Declaration on Sustainable Insurance, which we saw over 85 insurance companies in Africa for the first time commit to creating about 14 billion insurance facility to cover about 1.4 billion citizens against the climate risk that you mentioned: flood, drought, tropical cyclones in the next 27 years. So what would you say, very briefly, so I'll move to the next panelist, that needs to be done at every level so that insurance can optimally respond to build resilience of communities in the continent?
So I think there's a bit that's being done, but it's not enough. And that's really the allocation of funding to vulnerable communities in risk pool. So we are a risk pool. Governments have access to funding that they can use to respond to vulnerable communities, but it's not enough. I think that's really the key thing. But I think that what we also need is to understand that with the 97% protection gap, there's not going to be a single silver bullet. Different interventions have to take place in different circumstances. So you need both micro, meso, as well as the macro insurance to take care of the problem. And then also you also need to build to reduce the vulnerability of people. So people need to be able to rely on other income streams that are not necessarily dependent on agriculture, which is very difficult because more than 60% of the continent on average are involved in agriculture. But this is a multidimensional problem. But of course, the first thing to do is governments need to take advantage of the facilities that are available, especially with risk pools, because there is a lot of money that's not really being used in terms of premium financing. So that's really important. So I'll leave it there. There's so many things I could say, but we don't have time. So yeah, thank you.
Thank you very much, Malvin, for actually explaining that in very easy way to understand.